Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity.
Hello, my name is Tom Vassallo with MRW Financial Brokerage, and thank you for attending this episode of Long-Term Care Seed. On this episode of Long-Term Care Seed, we're going to compare traditional long-term care versus asset-based long-term care. And when I say asset-based long-term care, that means it's built on either a life insurance or an annuity chassis. And I know what many people say. They say right off, my client doesn't need an annuity, my client doesn't need life insurance, they just want long-term care insurance. But keep your mind open over the next 10 minutes. We're going to review and contrast the differences, and I think you'll see where asset-based long-term care really has a fit. When we talk about being built on a chassis, when I met my wife in college, she was driving around in a little red M3 BMW. Never in my life would I expect to see her driving an F-150 pickup truck. Of course, that's what a work pickup truck looks like. The F-150 Raptor is a little bit more. It doesn't matter which one. I can't see my wife in that vehicle. But what she does drive is a Lincoln Navigator. Now, what does an F-150 pickup truck and a Lincoln Navigator have to do with each other? They're both built on the same chassis. It's the F-150 chassis. The same can be said about asset-based long-term care insurance. It is built on a life insurance or an annuity chassis, but it's built from the ground up to address long-term care. Just like that Lincoln Navigator is built from the ground up to be a very different vehicle than the F-150, even though it sits on the F-150 chassis. And let's talk about some of the difference. We're going to compare and contrast Mutual of Omaha's Custom Solutions Plan to Nationwide's Care Matters Together product. And I base this on a married couple age 55 years old. First of all, and most important, Nationwide's policy, even if we do the pay to age 100 premium, we guarantee the premiums for life. There can never be a rate increase. That's not the case with Mutual of Omaha. They do have to apply with the state and have the rate increase approved by the state, but the premiums are not guaranteed for life. Also, with Nationwide Care Matters Together product, it does pay on a cash indemnity basis versus a reimbursement basis. So both of them are going to have identical benefit triggers. The inability to perform 2 of 6 activities of daily living, or you require supervision due to a cognitive impairment. But with Nationwide, as soon as you pull those benefit triggers, you just get a monthly check to spend it however you want. If you want to pay a family member to take care of you, that's not a problem. If your spouse is taking care of you and you just want to pocket the money, that is not a problem. With a reimbursement type policy, you must submit receipts from the licensed care provider, and the plan will reimburse up to the actual expenses or the monthly benefit, whichever is less. With Nationwide, they do have a 90-day elimination period, but once you meet that elimination period, that claim is paid retroactive to day one. So on the 91st day, the client's going to receive 3 months worth of benefits paid. Mutual of Omaha has a 90-day elimination period. We started off in this case where each spouse has a $6,000 a month benefit. With Nationwide, it's a combined 8-year benefit period. So whoever uses up those 8 years first, if they both went on claim at the same time, it would last for 4 years. If one spouse used all 8 years, that would leave the surviving spouse with no benefits. With Mutual of Omaha, we showed 2 individual 4-year benefits, and then we added the shared care rider, which means, if one spouse uses their 4 years of care, they could then dip into the other spouse's benefits. So essentially, it's the same benefit period. And we did show a 3% compound annual inflation rider on both. Now, I think everyone would agree, even outside the life insurance, we're looking at just the long-term care benefits here. Look at the premiums. With Nationwide, it's a pay to age 100 of the older insured. With Mutual of Omaha, it's a lifetime premium. And the combined annual premiums for Nationwide is $10,340, where it's $11,156 with Mutual of Omaha. Let's look at some of the additional benefits. But first, let's focus on this. When we look at just the pure long-term care benefits, the fact that the premiums are guaranteed for life, that it's a cash indemnity benefit, that the 90-day elimination period is paid retroactive to day one, and all of the other long-term care benefits are like for like. Nationwide, even though it's on a life insurance chassis, accomplishes that goal more efficiently than Mutual of Omaha. If we were to change Mutual of Omaha's elimination period to 0 days to try and mirror the paid to retroactive to day one with Nationwide, that would increase Mutual of Omaha's premium to $16,733. And with Nationwide, it's not use it or lose it for long-term care. If they don't use it for long-term care, there's a $218,000 survivorship death benefit. Now that death benefit is reduced dollar for dollar by claims paid. So to compare or contrast with Mutual of Omaha, we could add in their return of premium less claims rider. That pushes the premium up to $33,034, where Nationwide has that built in at the $10,340. But your client may not be interested in a 0-day elimination period, may not have children, and may not even worry about the return of premium. They just want to look at the pure long-term care benefit. And when we look at the pure long-term care benefit and compare and contrast the guaranteed level premiums for life with Nationwide versus that not having that premium guarantee with Mutual of Omaha, the cash indemnity with Nationwide versus the reimbursement with Mutual of Omaha, and the fact that the claim is paid retroactive to day one after you satisfy the elimination period, just looking at the long-term care benefits, you can see that we can accomplish this goal more efficiently with a Nationwide Care Matters Together product than we can with Mutual of Omaha. And let's not understate the guaranteed level premiums for life. And let's look at the real value of those guaranteed premiums. When we look at traditional long-term care, it's use it or lose it for long-term care. It is guaranteed renewable, which means premiums can be increased with state approval. With asset-based long-term care, there's a death benefit if not used for long-term care, and the rates are guaranteed for the life of a product. Here's a case study with Genworth. We had a male that purchased a policy at age 65. In 2020, his values, he had a $458.42 daily benefit, lifetime benefit period, 5% compound annual inflation rider, 100-day elimination period, and today he's age 77. His annual premium, $3,285. Now, of course, in 2020, he got a rate increase, May 8th of 2020. And that rate increase stepped in over 3 years and was a total of 40%. That started 90 days from this later. The increase will be phased in over multiple years, which was 3 years in this case. And you can see that 3-year rate increase. The premium before the increase was $3,285. August of 2020, it goes to $3,721. August of 2021, it goes to $4,158. And August of 2022, it goes to $4,599. But there's one other little note you need to see here, and it's buried in the letter, and it said, please note your policy will require a 318.6% premium increase for us to certify that no future rate increases will be anticipated. Since this rate increase is substantially below that amount, it's likely we will be requesting additional rate increases. However, if that should happen, we will provide advance notice for your available options. So we went through 2020, 2021, 2022 of the rate increases that were stated in this letter. They were saying we're going to need an additional 318%. We looked at the replacement options. Even when we get up to the $4,599 a month benefit, we can't buy a benefit with a lifetime benefit period at $13,000, almost $14,000 a month and come anywhere near the premium. It ranges from $16,000 a year to a high of $44,000, $48,000 a year, depending upon the carrier. It's $48,000 if we wanted to match the unlimited lifetime benefit period. So replacement is not an option. Now, let's look at the timeline for Genworth. His current premium was $3,285. May 8th of 2020, he got the 3-year phased-in increase of 40%. So his August 13th premium went up of 2020. His August 2021 premium went up. His August 2022 premium went up. And guess what he got on May 7th, 2023? another premium increase notice from Genworth on May 7th, 2023. So they phased in that 40% rate increase over 3 years. He got another 40% rate increase starting August of 2023 that's phased in. And please note now, this policy would require an additional 395% premium increase. Remember in 2020, it was just 318% premium increase. So when we look at this timeline, it started off at 3285, 2020 went to 3721, 2021, 2022, 2023, 5,210, 2024, 5,822, and 2025, 6,438. The client's real question is, what's going to happen in May 2025 or 2026? Is he going to get another premium increase? Well, they've already said they needed a 395% additional increase on top of the increases he's already had. So when we compare and contrast traditional long-term care versus asset-based long-term care, that guaranteed level premium for life cannot be understated. So when we look at this and say, number one, you have guaranteed level premium for life. It's cash indemnity, and the claim is paid retroactive after you receive the elimination, satisfy the 90-day elimination period. And on top of that, it's a lower premium. And if we start adding in some of the additional benefits, like the retroactive to day one, or the return of premium via the death benefit, you can see that this becomes a much more efficient solution, even though it's on a life insurance chassis. Even if you take away the death benefit, even if you take away the 0-day elimination period, it's still a more efficient option for your client. My name is Tom Vassallo with MRW Financial Brokerage. Thank you for participating in this episode of Long-Term Care Seed. I can be reached at 813-875-6331. I look forward to speaking with you and working with you in the future. Have a great day.